Shivani, it's 5:01. I think we can begin.
Yes. Hello, everyone. Welcome to the quarterly investor update call for UTI India Dynamic Equity Fund. The agenda for today's call will be introduction and welcome address by the CEO of UTI International, Mr. Praveen Japwani, followed by macro update on India by the Chief Investment Officer, UTI AMC, Mr. Vetri Subramaniam, followed by an update on the fund performance and future outlook for the UTI India Dynamic Equity Fund by the Head of Equities, Mr. Ajay Tyagi. We will also have a Q&A session at the end. Please feel free to post your questions on the chat box anytime during the call. I would now invite Mr. Praveen Japwani for the welcome address.
Thank you, Shivani. Well, good morning, good afternoon, everyone. Thank you so much for joining us. Our sequence of events is going to be, as Shivani has highlighted, our call has become fairly standard in its agenda now. So really pleased to be joining you again. The last few months have been very eventful. India has grabbed global headlines more than usual in the last few months, whether it was for the moon landing, the successful G20 summit. In fact, the Wall Street Journal reported that the cost of India's lunar expedition was less than the cost of the Oscar-winning film Interstellar. It starred Matt Damon and Anne Hathaway, I think it was about 6-7 years ago. Well, and this week, the headlines are about the diplomatic spat between India and Canada. You know, on any given day or week, the news is designed to be sensational. It is designed to be addictive. And the financial media seems to perpetuate the belief that this monthly or daily addiction to news and data, whether it's the CPI, IIP, PMI numbers, these things can somehow reveal some supreme cosmic mystery, some secret formula to make money, if only that were true. Yet the reality is, even the spat with Canada, or putting a rover on the moon, or the Adani saga, or even yesterday, the Fed leaving the rates unchanged, none of these events have an impact on the thousands of middle-class families in India, which next month will buy their first washing machine or their first motorcycle. And this is, I think, the critical defining factor about India's growth story, that as long as more and more people enter India's middle class, India's consumption story remains intact, and therefore, India's investment story remains intact. India's rise on the global stage seems to have coincided with, and to some degree sustained by, the implosion in China. Even early part of this year, 2023, a lot of the investment houses globally were actively recommending China exposure. Fast forward 6-7 months, they've all turned 180 degrees, and now a lot of attention is being thrust on India, particularly as we see the rise of the index EMX China. And for the past 2 decades, China was seen as the golden ticket, and now all of a sudden it can't catch a break. So really all hopes are pinned on India to somehow carry the world through its impending phase of low growth. To summarize, in sense of a global context, I'll make 2 points. One, the addiction to daily doses of sensational news, it encourages a behavior which is akin to market timing. And market timing isn't really investment behavior. And it's sad to see global retail investors fall prey to that. It's scary. Luckily for UTI, our global investors are institutional and therefore sophisticated and patient. So it's a lot easier to deal with. And we thank you for your business and thank you for joining this call. So that's the first point, addiction to daily doses, which is what we are seeing increasingly all over the world. And second, of course, is that we seem to be approaching an era where global growth is not so good. Of course, the word is out, whether it's going to be a recession, soft landing, hard landing, what have you. The outlook certainly is not very positive for the next couple of years. And this time around, China is not coming to the rescue. Yet there seems to be enough liquidity in the global system, which will aggressively try to find a home. and some of it will come to India, inevitably, as the world hunts for the next big growth story. So for the coming few months, I would say expect rising valuations in India as well as rising volatility. And with this, I segue into inviting my good friend and colleague, Vetri Subramaniam, CIO of UTI Group, to share his insights on India macro. Thank you.
Thank you. Thank you, Praveen, for that introduction and sort of laying out the pathway into today's conversation. And as you mentioned, I think it's now established into a reasonably set pattern. So what I'll do is first kick off with a little bit of a discussion on the macro, and then after that, hand over to Ajay. But I thought what would be interesting to do is actually kick off with a conversation about some more interesting statistics before we look at the standard numbers in terms of what's the traction in the economy and how earnings and valuations are faring. Maybe, look at some of the data bubbling through, which I think is going to be very important. This data is suggestive of underlying trends in the economy, which could significantly change the way one looks at the Indian economy in the years ahead. So I'm going to dive straight into that, and that's section 1, the macro trends. So yeah, if we just move on to the next slide, Shivani. So what I'm going to be talking about today, which may not come as a surprise to many of you, because I'm sure many of you have heard us talk about the India Dynamic Equity Fund and the fact that IT services has been one of the sectors in which the strategy has always had a very significant exposure. In fact, we've traditionally been overweight in the IT services area. But what I'm going to pick up over here is that this story of IT services is now changing the face of India's balance of payments, and it will certainly look set to significantly impact this in the years ahead. So if you look at this slide on the left-hand side, we have services, imports, and exports, and you can see 3 distinct time periods: 12 to 17, 2017 to 20, and then 20 to 23. So 2012, 2017 was a period of low growth in net services exports from India. It was -3% because imports were growing faster than exports. Then you come to the 17 to 20 period, and services exports from India are growing much faster than imports, and therefore the overall CAGR of net services is 11%. Then you look at the last 3 years, and services continues to accelerate in terms of exports even further, opening up the net balance significantly, and therefore the net balance has actually increased at 14%. So you can see the same number depicted on the right-hand side in terms of the CAGR of net services exports, and the important number to focus on is that net services exports on a rolling 12-month basis are now equal to almost $200 billion, right? So India is approximately a $3.5 trillion economy. Our net services exports, the surplus, is now $200 billion a year. Many people look at India as manufacturing and have always wondered how India would make its impact on the rest of the world in terms of being a production base for goods. And over there, we still punch way below our weight. But in services, at $200 billion, this is now quite significant. So if you just move to the next slide. Now, the point that I would really make over here is that when we break up services into what we call modern services and the traditional services. So traditional services could include, anything like container freight services being offered. So lots of services get offered related to cross-border transactions. But modern is what is typically delivered using digital or IT, right? So when you look at these charts on the left-hand side, you can see the growth in total global services and total India services. You can also see the 2 gray bars, which is the growth in modern services at a global context and modern services in India. Now, the striking thing over here is, as you wind your way to this period 2023, is look at the explosion that's happening in modern services growth in India, which is running at almost about a 17% CAGR, well ahead of the global number for modern services, which is running at about 8% per annum. So there has been a distinct acceleration. You can therefore see the impact that India is now having on the world in terms of its share of global services, in terms of both overall services and modern services. So India accounts for about 3.5% of total services. But if you look at its share of modern services, we now account for 8% of global modern services, right? So when you think about India's economy, about $3.5 trillion economy, we're punching above that level when it comes to our share of overall services trade, but we are punching at 2x that number when it comes to modern services. Now, what are modern services? Predominantly, these are, of course, the IT services that we have talked about. These could be, somebody picking up a telephone call when you call your financial services provider or your healthcare provider in the US or Europe, and somebody in India is picking up that phone call. But that is no longer the only story in India. The biggest story in India has now been the coming of age of the services economy in terms of integrating itself into the core of global enterprises. So let me give you a simple example. If you look at a company like Mercedes-Benz, they currently say they have about 25,000 engineering and research professionals engaged at about 5 sites all across 25 locations all over the world. 8,000 of those professionals are based at 2 locations in India. So 1/3 of their total R&D professionals are now based out of India, and they work on all the elements that you would expect of the modern day economy: automotive, autonomous driving, connected and EV mobility. So the sort of software eating the world story is now visible in a company like Mercedes-Benz, which is as old economy as it gets, and they've got nearly 1/3 of their global R&D professionals sitting here in India. Now, the company that's been the talk of the market this year, NVIDIA, the CEO was recently in India alongside the entire G20 event. And one of the things that he mentioned is that out of NVIDIA's global employee base, so they have about 25,000 employees globally. The number 1 country for their employees is obviously the US, but the number 2 geography where they have people employed with NVIDIA is India, upwards of 4,000 people. And they expect that this number could maybe double over the next few years. So it is really this integration into the global system, no longer just being third-party IT services, but increasingly Indian, engineers and other qualified professionals sitting at the heart of global enterprises in terms of running their systems. If you look at the asset management industry, many of the companies globally today run their entire global back office, doing everything from social media to accounting, to fund accounting, to R&D services, to cash flow management. They're all run out of teams based out of India. So that is what is leading to this significant spike in terms of India's contribution to global services, the modern services in particular. So quickly, just on the next slide, and this is just a big picture implication of the trend that we are seeing. Now, those of you who are keen observers of India would know that India has typically dealt with a problem of a significant trade deficit. And when I say trade deficit, I'm referring to the deficit for goods. The goods deficit in India is driven by 3 things. It's driven by oil, because we don't have much oil that we produce locally. It's increasingly driven by electronics, but we've talked in the past about government policies to promote electronics manufacturing in India. And finally, it's driven by India's thirst for buying gold, which I don't see going away anytime soon. But here's the interesting part of the conversation, which is if you look at the 12-month rolling trade deficit of goods, which is $265 billion, Today, the trade surplus, including invisibles, is up to $200 billion. And if you continue to project the kind of growth that it has seen in recent times, it's very likely that by the time we get to about 27 or 28, you're actually going to have a parity between the services surplus and the goods deficit, leave alone any potential success India might have with all the schemes that we are running to increase the share of manufacturing in our GDP, schemes like the production linked incentive that we've talked about in the past to increase very specifically India's production capabilities in the electronics domain. So irrespective of that, the current trend suggests that the services surplus along with invisible surpluses will more or less fully sort of offset the traditional goods deficit that India has had. So, to my mind, this completely changes the picture where people in the past used to ask me, if India is such a great production base, how come you are not a significant player in the global world? How come you don't have a trade surplus? I'm not forecasting a trade surplus, but I'm just suggesting that India's unique capabilities in terms of the number of qualified professionals that's able to put out. We have almost 1.5 million engineering graduates who pass out every year. And in a world which is increasingly running short of people, it's causing people to place their intellectual resources and use the intellectual base of professionals available in India and integrate it into their global system. So, who knows, maybe in 5 years' time, we'll actually have a situation where India is no longer traditionally running the deficit that we have associated with its aggregate trade of goods and services. So this is sort of the big picture I wanted to share. I'll just quickly fast forward over the next few slides, which talk more about where we are in terms of growth trends. Now, all of you are familiar with this. The Bloomberg forecast for FY24 on the right extreme is GDP growth of about 6.1%. The first quarter of this year was gangbusters. Remember, FY24 in India means the year ended March 24. That's the fiscal year in India. The first quarter GDP came in at almost 7.8%, but we do think the trajectory will slow down over the course of the year because of the base impact. And as a result of that, the current Bloomberg estimate is about 6.1%. The central bank thinks it will be closer to about 6.4, 6.5%. If you just jump through, the next one is the high frequency. We've got the earnings expectations over here. I'll just point at those 4 bars in the middle. Right now, these are the earnings estimates for the year ended March 24, the 4 bars in the middle, FY24. And what you can see here is that from the period September 22, when the forecast was 939, we've actually seen an upward movement in earnings estimates. It's been stable now from December 22 at about 980, 990 rupees for the year ended March 24. Now, the reason I point to this is that the typical 4 bars in India look more like what you see on the left-hand side for March 23, where in June 22, the expectation was 886. And by the time you got to March 23, the expectation had actually declined to 832. So this time around, there's actually been some stability in forward earnings forecast, though I do think the bar is still slightly high, but there's been a lot more stability in earnings forecast. And that's unusual given the typical pattern that we are accustomed to in India, where over the course of the financial year, earnings actually end up getting cut. So quickly, we jump through to the next slide. This is a slide on valuations. This is for the Nifty 500 index. So the top 500 companies in India covers large cap, mid cap, small cap, obviously biased towards large cap because it's a weighted index. I think the picture is self-evident. I think Praveen alluded to this earlier. It is an expensive market compared to its 17-year history. You can see here we're almost at a 20% premium to that. We're about 1 standard deviation above the long-term average. So it is a pretty pricey market, and no doubt a lot of expectations in terms of the potential of India, in a sense, already reflected in where the valuations are at this point of time. Moving on from this to the next sort of slide. So very quickly, I think everybody is familiar. The US economic data has been robust, but inflation well above the 2% target. So we just heard the Federal Reserve speak yesterday. But what about India? I think in India, the Monetary Policy Committee has held rates unchanged in the last two meetings. That is simply because they've felt that they've done enough at this point of time. And looking at they do have some concerns about inflation being outside the comfort zone. It spiked to 7.44% in July, but that was significantly driven by some dislocations and the weak start to the monsoon, which caused food prices to spike up. But they've chosen to look through it, saying that they also think there is some downside risk to growth estimates coming through from what's happening in the global economy, and therefore they prefer to remain on pause. I think in India, the expectation that we would have of the MPC is that their preferred stance would be to remain on pause. They are keeping liquidity tight, very unlike the US, where liquidity conditions have actually remained quite loose. In India, they've actually tightened liquidity quite a bit, and I think they're quite comfortable, therefore, with that situation. We don't see any rate cuts in a hurry, certainly not in an environment where the US maybe still has one rate hike left on the table, but they will look through food inflation at this point of time. And I think any rate cuts in India are really a FY25 story. So, we could be talking about June, July of 24 before there's any visibility of a rate cut. Now, earnings growth, as I mentioned earlier, very strong in the first quarter of 24, but some of that is just margin normalization. There's a 19% growth expectation for the Nifty 50 set of companies for March 24. I think it's a high bar because, underlying growth in some of the areas is still a little bit soft. But, the good news is that for the last 3 quarters, the estimates have remained stable. The more interesting point is on valuations. There's been a gangbuster rally in small cap and mid cap stocks in India over the last 3 to 4 months. I don't think this is similar to the trends we've seen in the US or in other markets. This is very unique to India, perhaps a function of strong domestic appetite for equities coming through. But it's for one of the rare times in my own sort of career where I'm actually seeing the mid cap and small cap trade very pricey. In fact, in many cases at a premium to large caps. And therefore, we see a lot more comfort on a relative basis in the large cap segment of the market. And what we've been recommending to investors in general is to follow a bit of a staggered approach towards equities, given where we are in the valuation cycle and the burden of expectations in terms of earnings growth. So I'll pause over here and hand over to Ajay. I will be around for any more questions, but I'll let Ajay talk about the investment strategy at this point. Over to you.
Yeah, thanks, Vetri, and good morning and good afternoon, everyone. As is usual, I will just start by recapitulating the core philosophy of UTI India Dynamic Equity Fund shown on the next slide. So, like we've been consistently saying, the focus of our fund and our philosophy is basically finding out businesses that create economic value. And I'll discuss the events of the last 6 months and the last 1 year. But all I can say is that regardless of what's happening in the market, regardless of whether quality is being punished or quality is being rewarded, we would consistently stick to businesses that show these quality characteristics, that have the inherent ability to create economic value, because we are believers in the fact that alpha generation is best done when you are sticking to businesses that are creating economic value and compounding that economic value. And that leads us to the second important facet of our philosophy, which is looking for businesses that have the ability to grow higher than the country's nominal GDP growth. So we of course dig deeper into finding out drivers for this sustainable growth. And once we are convinced that these growth numbers would remain strong for the years to come, if not decades to come, that is when we pull the trigger. Last but not the least, valuation. And the good news is that because of the relative underperformance of quality versus value, the valuations for all quality-oriented strategies in India is now below their own averages. Moving on. This is the performance summary for us over the last 10 years, both on a calendar year basis as well as rolling returns as of 31st of August. Year to date, we have managed to outperform. On a one-year basis, we are just about there. But India has been very unique in terms of how the last 12 months have played out. While we can move to the next slide. While we have seen, quality making a comeback, that has not been the case here in India. I'll come to that in a bit, but before going there, let's also just have a very quick look at the key detractors and the contributors to our year-to-date performance. Like I was mentioning, in India, value continues to do well. Quality and growth is still underperforming value, and that is also getting reflected in terms of our key detractors. The typical value names like Tata Motors, Mahindra and Mahindra, which are two auto companies in India, and Larsen and Toubro, which is basically a diversified conglomerate, with the core being industrial and construction related businesses. They have done very well, and purely from the perspective of very poor return on capital, we've never been an investor into any of these names. This has led to some bit of drag on our performance. Tobacco stocks and thermal power utilities. In fact, I would say all kinds of utilities, but even thermal utilities, the ones which are basically managing coal-fired power plants, have done very well in India. From the perspective of ESG, we obviously don't invest into such kind of businesses, so we've also missed out on the rally in such kind of companies. Of course, when it comes to holding on to growth companies, when it comes to holding on to businesses which we feel have the ability to create economic value, which have a winning business model, many of them continue to underperform, even in this calendar year. So large cap growth names like Avenue Supermarts and HDFC Bank. Avenue Supermarts is India's second largest grocery retailer. I've discussed this company with you many times in the past as well. HDFC Bank is India's largest private sector bank. They are some of our top holdings. They are part of our top holdings. Both of them have continued to underperform. Last but not the least, and this is something which has happened more in the last 3 to 4 months, is the very strong performance by public sector companies. You may be familiar of public sector companies in India, which also in certain other parts of the world are called as state-owned enterprises. They've had a very strong rally against MSCI India, moving up by 6% year to date. The PSU index has moved up by 17% year to date. And here you find companies from the financial services sector, from the energy sector, from utilities space, all across. And, again, the continuation in the value rally, or let's say the fact that value-oriented businesses, the ones which are still cheap on price to book value, price to earnings, are the ones which are moving up in the market. And a typical PSU is the one where capital allocation has never been a strength. As a consequence, return on capital ratios are very poor, and they have continuously traded cheap. But in the current set of circumstances, there are investors who are, enjoying the ride in them, because there is a re-rating happening in these businesses without any significant change in their underlying fundamental outlook. And we've obviously stayed away from them because, like I mentioned upfront, we want to focus only on those businesses where we see, we want to basically look at the outcomes of the business over the next 3 to 5 years rather than trying to participate in momentum. And this again has been a source of drag for us. When it comes to contributors, the one thing that many of us discussed in the last call, and I think in the first quarter of this calendar year, the episode around the Adani group of companies happened. We've never invested into any of the Adani group of companies, so that obviously has helped us. IT services, which was a drag in 2022, has actually been a contributor this year. There has been stability in that sector. There was a massive derating that happened in 2022, but hopefully a lot of investors realize that their business models are very stable and predictable, and they're not like one of those companies which would suffer if external sources of capital are not available. In fact, all of these business models that we hold are highly cash generating business models. So companies like LTI Mindtree, which is one of our top 3 holdings, and also Coforge, which is part of our top 10 holdings, have done very well. Lastly, mid and small caps, although I would say that even in mid and small caps, the rally has more been on the value side rather than the quality side. But notwithstanding that, there have been a few names in our portfolio from the mid and small cap part of the portfolio which have done well, and they have also contributed to our performance. Yeah. The next slide essentially is, a snapshot of how quality and value have played out in different parts of the world. Let's start with India first on the top. And we've basically picked up this data all the way back to 2020. 2020, as you can see, in India, quality outperformed value. But then 2021, it significantly underperformed. So was the case in 2022. And even in 2023, quality continues to underperform value. If you try to make a comparison to the global markets and the US markets, you would see a very, very different picture there. Like 2020, quality did outperform value significantly. But 2021 was a very even kind of year, globally as well as in the US. Quality and value are almost neck and neck, unlike India, where there was a massive underperformance in quality. 2022, obviously, everywhere globally as well as in India, we saw a rotation out of growth stocks, quality stocks into value. But unfortunately, India hasn't witnessed the swing back into quality and growth like the world and the US markets have witnessed. And I think that's what has complicated matters for a highly quality or growth focused investor like us. But we remain resolute about the fact that what will ultimately decide our portfolio holdings would be our understanding of the underlying business, rather than our view about when would rotation into growth or rotation into quality start to happen. Yeah, next. So as explained in the last couple of slides, because of quality still not coming back into focus, if you look at the premium of our fund versus MSCI India, we are still trading below the long-term average. So being a quality growth focused strategy, we are expected to be having a price earnings multiple higher than the market. So our average over the last 10 years is around 40%. So we trade at a 40% premium to MSCI India. But of course, there are times when we go above the average, just like there are times when we go below the average. As you can see here, for the last 3 years, we have been below the average, which in a way is good news for investors, because if you are hoping for a reversion, then you are just at the right time. And secondly, as far as the quality of the portfolio and the characteristics of the portfolio are concerned, they remain as solid as they have ever been. Yeah. Let's move on. As is customary, I will just take you through 2 examples of companies in our portfolio, and we always endeavor to pick those stocks which we have not discussed historically. So this time we are having Kotak Mahindra Bank, one of the large private sector banks in India, in front of us. This is part of our top 10 holdings, has been so for the last 10 years. Although the stock hasn't done very well, but the business remains as solid as ever. Firstly, the big picture, the credit market in India is about $1.8 trillion, growing at about 13%. Credit growth in India still remains very strong. And India is not an overheated market in terms of the penetration of debt. Household debt to GDP is under 40%. It has been around this number for 20 years now. In fact, for most economies post the financial crisis, the household debt to GDP started to increase. In some cases, increased significantly. In India, it has been around this number post GFC as well, just like it has been around this number for almost 2 decades. So we're not in an overheated market where accidents can happen. The growth in this market has been more on account of the disposable income also increasing very healthily for consumers, and these consumers haven't over leveraged themselves while enjoying the consumption boom. As far as the bank is concerned, it just has a very small 2.2% market share. So it's not a large size bank to that extent. Therefore, the ability to continue growing faster than the market is still there. And very significantly, it's not purely a lender. In fact, Kotak Bank is a full services bank, which basically enjoys a very strong position in financial services, like asset management, like broking, like investment banking, like insurance, like wealth, and so on. So it's really a very well-run institution, more on the lines of a financial supermarket, not only doing lending but doing all other activities, and technology-driven, which is borne out by the fact that 95% of the new loans are actually being given out basis basis technology. They're all being originated digitally. Last but not the least, the business model of any bank finally gets down to this number of ROA. And Kotak has been one of the very few banks in India, and I would say globally, which has been consistently delivering an ROA of 2% while showing a strong growth as well. I did mention that the stock hasn't done well. It's also because of a bit of a change in management overhang. The promoter, who was also the managing director and CEO of the bank, is moving on, but they have a very strong senior management team, and this senior management team has been with the bank for almost 3 decades now. One of them is expected to pick up this role and take the bank forward, while the DNA of the bank, to our mind, is shall continue to remain the same. Yeah. If we just talk about certain numbers now, the bank has given a very strong NII growth of about 20% plus and profit growth of 23% over the last 10 years, while maintaining strong ROAs, average ROAs of 1.8%. And also on the right-hand side, you can see how the loan book and the profits have moved up consistently over the last 10 years. Yeah. I'll now talk about the next company, which is PI Industries. Now, this could be, okay, before I go there, this is basically the performance chart for Kotak Bank. In the green, you can see the price line, and you can see that it's basically gone nowhere over the last almost 3 years. While the markets have actually been on a tear, but private sector banks like Kotak and HDFC have just remained sideways, despite the fact that we saw in the previous slide that the profits continue to grow, ROAs continue to remain steady. And all of this has happened because the valuations have derated significantly, as is shown in the white line here. And valuations are certainly at a 5-year low. In fact, for both Kotak and HDFC Bank, valuations are pretty much at their 10 and 15-year low as well. So such has been the massive shift away from quality into value over the last 3 years, that even companies like very well-managed companies like Kotak and HDFC on the banking side, and of course, there are examples, equal number of examples in other sectors, all such companies have suffered badly. Yeah. We move on to the next example now, which is PI Industries. It may interest some of you who are keen to know whether the fact that supply chains are wanting to get more diversified now, which means that business will to some extent shift out of China into certain other countries. This company is a perfect example for that. It is one of the leading chemicals company in India, focused more on agrochemicals. And it partners with global giants like BASF, Syngenta, Bayer, QMI of Japan, and so on. And a strong business model has been built over the last 20 years by this company by being a partner to these global agchem giants. And they do a lot of manufacturing here in India for these giants. So in a way, it's outsourcing of the manufacturing activity of some of these agchem majors, typically on the innovator molecules and not so much on the the molecules which have already gone ex-patent or have got genericized. And I think, like I mentioned, the fact that in a few sectors where India has been strong, namely auto and auto ancillaries predominantly in pharmaceuticals, in chemicals. I think in these sectors, the China plus one opportunity is for real, and companies like PI Industries are marching ahead by not only showing their normative organic growth, but also showing faster than organic growth because of new opportunities that are emerging. If you go to the next slide now, this is basically the performance of the company over the last 10 years. Strong sales growth of around 20% and profit growth of 24% annualized over the last 10 years. The core of the business, which is the custom synthesis business, which is where they partner with the global giants, has grown at 24% at a very healthy rate without compromising on profitability. Return on invested capital has been 23% over the last 10 years, with very strong and healthy cash flow generation and also very strong and healthy EBITDA to cash flow conversion. Yeah. The next slide shows how the stock has performed. The green line is basically the price line. Unlike Kotak, here we see some movement, although not to the extent of the underlying growth in the business. And here again, the multiples have derated. The white line is basically the price earnings multiple, which we can see has got derated over the last last 2-3 years. I would say, given the expected the price movement to be much sharper, but it hasn't been. And that is why I was mentioning that while there has been a mid and small cap rally, but that rally has not been even. The mid and small cap rally has been more in the value camp compared to the quality camp. We move on to our sectoral breakup, and the next couple of slides basically will show where our portfolio stands in terms of our sectoral holdings or our top holdings. And we just want to flag one point here, which is that nothing much has changed in our view. Our sectoral holdings remain the same as they were last year. Banking, financial services, consumer, IT, healthcare, they are the key sectors which we feel are our favorites, of course, and are best suited to churn out business models which will capture India's growth in the coming decade. Nothing changes here. The next slide is our top 15 holdings. Here again, nothing much has changed. I would just make a very quick mention here. 2 of our holdings have seen a merger. In a way, I should say 4 of our top 15 holdings have seen a merger. LTI Infotech and L&T Infotech, Larsen & Toubro Infotech and Mindtree merged to become LTI Mindtree. This happened in December of last year. So on the right-hand side, stock number 7 and number 11 merged together, and therefore they've become the second largest holding. HDFC Bank and HDFC merged about a month back. On a combined basis, they show up as HDFC Bank as our largest holding. So that's on account of this merger, there is slight change in our holdings. But otherwise, if you were to have a closer look at the portfolio, again, the same story. We continue to love our businesses from a longer term perspective. In fact, if something has corrected purely on account of reasons outside of the fundamental performance of the business, we have always taken advantage of it. We have always pruned exposure in businesses which have seen a sharp rally without a commensurate improvement in fundamentals, and vice versa. Yeah, next please. New entrants and exits. In fact, there have been no exits per se over the last 12 months, but there have been some new entrants. We've taken advantage of the sharp correction in growth stocks over the last 1.5 years now to build exposure into certain companies which have been on our radar for, I would say almost 2 years now. A small exposure, as is very usual, is what our starting point always is. And then from there, we slowly and gradually build on. These are the 3 companies. Persistent is a mid-tier IT services company. Trent is India's second largest fashion retailer. Dixon is basically India's largest electronic manufacturing services player. Now, this is a very strong theme that has been emerging in India. Dixon is obviously at the forefront of it. And even before the government started pushing a lot of domestic manufacturing in the country by coming out with incentives in the form of the PLI scheme, which we have discussed in the past as well. Even before that, Dixon had made very strong inroads into this industry by having a very strong client roster. But of course, the PLI scheme, which started 2 years back, has given a strong fillip to all such players, including Dixon. And I think you may have heard about India also putting up a ban in terms of importing electronic items like laptops and PCs. These are steps taken by the government to promote domestic manufacturing. In fact, there is no option left now but to just manufacture all of these things domestically. And outsourcing partners like Dixon would take advantage of this. I just want to make one final quick point that the number of holdings in the portfolio also haven't changed much. Same time last year, we had 54 holdings. Today, we have 55 holdings. We have always maintained that we feel comfortable managing this strategy with about 50 to 60 stocks. We are right in the middle of that number. Yeah. Okay, just the last slide. We've shown this slide consistently over the last few quarters. We just added the year-to-date 2023 to this slide at the bottom. The story remains the same. While we don't sell out of businesses just because they have become expensive, but we definitely reduce our exposure when we see a sharp run-up. I had shown you that Coforge has been a big contributor to our performance this year, has gone up by 56% over the last 1 year. We have used this opportunity to prune exposure in Coforge. It is our highest sold stock for this year. We are just respecting the allocation that we want to have of Coforge. So when it was falling last year, we were buying it because we didn't want the exposure to go below 3%. This year, when it's been rising very steadily, we've again tried to keep the exposure close to 3%. That's the story with all the other names as well on the sell side, whether it's Astral or Ajanta. On the buy side, I would say all of these names which we like but have performed badly despite the markets moving up are the ones where we have been consistently buying. So I think the overall theme remains the same. We always are looking at valuing companies from a 3 to 5 year perspective, basis their business outcome. And if stock prices are moving one way or the other, more on account of near-term factors or sentimental factors, we would want to be anti-consensus and take advantage of that. So I think that was the last slide. I guess we can now open up for Q&A. Thank you.
Thank you, Ajay. Thank you, Vetri, for such an insightful session. We will now open the Q&A session. The first question is for Vetri. Aren't Indian markets' high valuation measures already integrating the positive economic outlook?
Sure. Thanks, Shivani. And in the interest of time, we'll just keep all the answers to the point. So very quickly, if you look at the Nifty valuations at this point of time, we already had a chart earlier. It's certainly trading at a high premium to sort of the long-term average. But very interestingly, if you look at our own strategy, which typically has a premium to the market, actually our premium to that market has actually come down now. And that's a function of market valuations going up. On a relative basis, we have more comfort in large caps as compared to mid caps and small caps. But, there's no running away from it. So I just answer the burden of expectations is on the market, and the market needs to, or rather the companies need to deliver on those earnings numbers.
Thank you, Vetri. The second question is also for you. India versus China, is it a zero-sum game? How is India reacting to the changes in the region? Would also be interesting to understand more about the ever-changing relationship between India and China.
Sure. So when you say ever-changing relationship with China, that's a little hard to understand because, you know, those of you who are familiar with our history, there was a war with China, very brief war, just lasted a few days, all the way back in 1962. There is an unsettled border running across several parts of the northern territory of India. And for the last and these border issues have been outstanding again for 40 years, you could argue, maybe even 70 years plus. And in 2020, during the height of the pandemic, there was an amping up, I would say, by China at the border on some of these, areas which have always been disputed. They tried to sort of exercise their control. And I would say that was actually the point of conflagration, where a spark got lit. And that's really the point where relationships with China, understandably from our point of view, have gone completely south. And, we don't really see any change in that. In fact, India's stated stance is that till such time China pulls back from those border areas which are yet to be resolved, there is no question of any talks with China at this point of time. So I would say it's really a standoff between the two countries. And when you look at all the policy decisions India has taken in terms of designating companies from certain, neighboring countries as being companies from which we would not wish to, receive any FDI. These are all policies which have been brought in place only to send a very strong, message to China that, what's happening at the border is unacceptable. So I think this will remain an area of, some bit of tension between the two countries. Mind you, the trade deficit between the two countries and trade between the two countries is still running at a record level, but I think that's certainly something India would like to target going ahead. When you say zero-sum game, I'm not sure what you're pointing to. I'm certain as far as FPIs are concerned, foreign institutional investors, they're obviously constantly juggling with overweight China or overweight India. So you could argue some of that is zero-sum. But I think the bigger story is one of how companies are looking to move their supply chain dependencies on China to other geographies. And India, along with Vietnam, Indonesia, Thailand, Malaysia, Mexico for that matter, are the beneficiaries of this trend of companies looking to relocate their supply chains to other geographies. So I think that will be a trend that will continue to benefit India in the years ahead.
Thank you, Vetri. The next question is for you, Ajay. Could you comment on the outperformance of small and mid caps in the past few years? Do you think this outperformance is sustainable? Are you still comfortable with valuations of small and mid caps in your portfolio? Can you still identify new opportunities in this space? And also, are you planning to reduce the weight there?
Sure. Multiple questions rolled into one. I would say comfort around mid and small caps. Absolutely no. Vetri alluded to this. If we compartmentalize the market into three segments, large, mid, and small, I think small has already gone into a outrageous territory. We've seen a massive rally in the last 6 months, and I think that stopped making sense to us. Mid, yes, higher than our comfort for sure, but not as bad as we see on the small cap side. Although things are slightly higher than what should be warranted. Large is the one where yes, valuations are higher than average, but they're still making sense to us. So from that perspective, mid and small cap clearly into small cap clearly into outrageous territory, mid into the territory or category where we're not comfortable. How are we approaching this? Look, we continue to remain bottom up. We've never run this strategy, looking at different segments of the market, different sectors or different market cap buckets and saying, let's steer the portfolio into any one direction purely because valuations are attractive or maybe not so attractive. So that's not the way we run our strategy anyway. We basically try and build exposure around businesses, looking at their prospects and their outcomes over the next 5 years. We will continue to do that. Yes, if something moves up sharply, like I showed you in one of those slides, we would prune down exposure. That we always do regardless of whether there's a mid-cap rally or not. If there's a large cap rally and some of our names reach valuations which are not comfortable, we'll prune them as well. And that's what we have done consistently. So So that's how we tackle, this issue of overvaluation in our portfolio. Last but not the least, I did make a passing reference. Even when you dig deeper into the mid and small cap rally, it's been overdone in the value segment particularly. If I look at my own portfolio, apart from a few names, there hasn't been a massive rally in some of those names. Last point I want to make here is for those of you who really want to, take this further, please look at the very strong mid and small cap rally of 2017 and 18. And of course, after that, mid caps had a very horrible time in 2016 and 17 was the mid and small cap rally, after which 2018 and 19 was horrible for mid and small caps. If I remember correctly, apart from a couple of names in our portfolio, most of these mid and small cap companies went out to make new highs in 19 and 20 when there was actually carnage in that segment in general. Ultimately, all I'm trying to once again reiterate is, if the business model is strong, then you really need not worry about what's happening in the segment in general. Yeah.
Thank you, Ajay. The next question is also for you. The fund is outperforming a YTD. What have been the main drivers of outperformance? Are we approaching the end of the value cycle? What would be a catalyst for upward re-rating of growth stocks in India?
Shivani, I think we discussed the contributors or the drags to the performance, so I won't repeat that. We have a slide on that. Are we approaching the end of the value rally? Quite frankly, I'm not sure. Who knows? I could be biased at this and say that, look, growth hasn't done well for 2 years. So obviously, it means that the reversion should take place and should take place soon. But quite frankly, nobody knows. Maybe another 3 months, maybe another 6 months, maybe tomorrow. So that's some. But we remain convinced about the fact that ultimately, in the fullness of time, wealth will get created out of business models which clearly are demonstrating intrinsic value creation and compounding of that intrinsic value. So we would just remain focused on that. Yeah.
Thank you, Ajay. The next question is for Vetri. Would be interesting to hear about the Indian general election next year, possible outcome and the risk attached to this election.
Well, all the opinion polls, and there have been a few recent polls, both in terms of assessing the popularity of Mr. Modi, who will certainly lead his party into the next election, alongside certain other leaders who could be potential leaders of a alliance which is sort of trying to come together at this point of time to compete under one banner against the BJP and Mr. Modi's party. But I would say he's head and shoulders. That's what the opinion polls show. Maybe a combined opposition would be able to put up a better showing, but all the evidence we have on the ground in terms of polling data suggests that at this point of time, Mr. Modi and the BJP is the shoe-in to win the next election in May 2024. There were some rumors a few weeks ago when a special parliament session was convened this week that the elections could be called earlier, but there's no sign of that. That session ends tomorrow, and doesn't look like there's anything in terms of an earlier election happening. So I think it will be on cue, and at this point of time, reading the political winds as they are, it's hard to say there'll be a negative surprise. But I should also remember what I think one very famous British Prime Minister said many years ago, that 2 weeks is a long time in politics. So who knows? We're still 6 months away.
Thank you, Vetri. The next question is for Ajay. How do you explain strong performance of PSUs? It is a detractor from performance for you. Any concerns in this matter?
No, concern, as in, of course, the concern is that we refuse to participate in this rally, and therefore that's leading to a drag on our performance. So we are concerned that this rally shouldn't go on forever, endlessly. But yeah, I mean, having seen and studied these PSUs for more than 2 decades, and seeing how these institutions operate, the fact that the respect for capital is very low, the fact that they are in some sense extended arms of the government and do a lot of things which the government wants to do for the public at large, also means that they don't have profits and profitability at the core of their operations. So yes, from that perspective, I would say Are we unduly worried about PSUs being totally transformed and we missing out on these business models? The answer clearly is a big no. There is no transformation per se that has happened. But yes, these PSUs do participate once every 4-5 years whenever there's a huge value rally. Do remember, these are typically lowly valued businesses on price to book, price earnings multiple, and therefore just become favorites of investors whenever whenever there's a value rally going on. Yeah.
Thank you, Ajay. The next question is also for you. What are the factors that could lead to a bear case scenario for Indian equities over the next 12 months?
Shivani, usually post the event, the factors become evident. So, after the event plays out, I think we would be discussing, look, this was so evident. It's not as evident today, but I can just certainly flag out a few risk factors. I think Vetri did mention about the proof of burden now being on these companies delivering on growth. So yes, one risk factor is that growth slightly weakens on account of global or local factors. And if that growth is to weaken, then, the high valuations today could be marked down significantly. That's a very shorter term risk. The other risk is, of course, boiling crude prices. We've discussed this many times in the past. High crude prices are never good for a country like India. High crude prices seep into our fiscal deficit. The government is forced to give subsidies, which not only spoils the balance sheet of the government, but also means less money for other important activities, which could have a multiplier effect. So yes, I mean, that's the other risk which I see. Vetri, I don't know whether you want to chime in with any other risk that you can visualize.
Well, I think the only obvious one is political. As I said, today that's zero risk. Perhaps base case is Mr. Modi wins, and the market is certainly very happy with Mr. Modi's leadership. But it's always volatile heading into an election. My recollections of elections in 2009, 2014, they can be volatile, though sometimes it also goes into a holding pattern. But that's like a spring which then releases the volatility thereafter. So forth.
Thank you. The next question is again for Ajay. There is a growing view among the market professionals that inflation in the developed world will stay high, interest rates in developed markets will stay high, and oil prices will stay above USD 100. What would be the fund strategy in such a scenario?
Shweta, your voice dropped in the initial part of the question. Can you repeat?
There is a growing view among the market professionals that inflation in the developed world will stay high, interest rates in developed markets will stay high, and oil prices will stay above USD 100.
Sure.
What would be the fund strategy?
Sure. See, the short answer is our strategy will not change, because our strategy is focused, like I've said many times in this call as well, on the outcomes of businesses. I think implied in this question is the fact that if inflation stays high, oil prices stay high, therefore interest rates stay higher for longer, does this not impact growth stocks? Well, all I can say is if you go back to the decade of the 1990s, and if you look at how interest rates behave in that decade, on an average the Fed funds rate staying around 5% in that whole decade. And if you also then recollect that did growth stocks did well during that decade, or did value stocks do well, you will get your answers. I think it's been very simplistic in the last 18 months to say that, look, higher discount rates definitely mean growth stocks are going to be less attractive. Well, yes, there has to be a reset of higher discount rates into the valuation one time. But if you were to just extrapolate that and say that, look, till the time discount rates don't come down significantly, growth stocks will not do well, I don't think either that is mathematically true, or even when you look at history, has been historically true. I would just urge you to go back to the era of 1990s to test this hypothesis. Yeah.
Thank you, Ajay. The next question is to Vetri. What has held India back to become a manufacturing superpower like China? What needs to change in India for them to become a leading manufacturing power? This seems like a massive opportunity India seems to be sleeping on.
Well, I wouldn't say we've been sleeping on it. We've tried several times, but I think this goes back to first principles. This is not really something that can be addressed, to my mind at least, by way of government schemes. The government's production-linked incentive scheme is a great step forward, but really it goes to the core of manufacturing competitiveness, which is everything to do with the cost of power, the cost of doing business, the cost of logistics, removing infrastructure bottlenecks. It's just a very slow process, and I think that's something that we'll just have to deal with. And we are having to deal with this in a market where, most infrastructure in the market has been historically created by government. Then we went through a period where it was done through public-private partnership, and it's only in the last 5 to 6 years that we've again sort of moved the infrastructure building mandate back to government. But I think that's going to be a lot more of a slow, long drawn-out process, and we can do a whole conversation about India's manufacturing prowess or lack of it and how we can turn that around. But maybe we should leave that for another day. Very quickly, Shivani, I just noticed 1 or 2 questions which came in the chat. So maybe I'll just quickly answer those. One question was, what are the invisibles on slide 5? I'm glad somebody noticed that. Remember, India receives the largest amount of remittances from Indians who are actually working overseas. So traditionally, this was many Indians who worked in the Middle East, worked in the oil-driven economies, and they constitute a large portion of the workforce in those oil economies. But increasingly, the invisibles are the remittances which are coming from Indians who work in the developed markets, particularly the US and Europe. So if I go back a decade, 70% of the remittances came in from the Middle East. Today, about 60% of the remittances come in from Indians employed in the developed markets. And the total remittances that come into India are in the region of about $85 to $95 billion, which is, simply put, it's export of labor, so to speak. So that's the invisibles number. There's another question which is coming about a statistic which got reported yesterday, which is the share of household financial savings came down quite sharply. Actually, it's been coming down over a 4 to 5 year period. In 2023, it dropped to about 5.1%. I would just say that this is a mirror image of the way India has managed its macroeconomy over this pandemic period. So unlike many other countries who allowed the fiscal deficit to get very, very elevated and put transfers into the wallets and pockets of the households and businesses, India did not do that so aggressively, which is why India's fiscal deficit, after ballooning in the first year, has already started to come down. The target is 5.9% this year, and we think we'll go down to about 4.5% over the next 3 years, which would bring us well back to the pre-pandemic trajectory of fiscal deficits. But obviously, some of that pain has now been picked up by the households who, unlike households in other parts of the world, didn't get transfers. So that's the pain that's registered. But as we see the economy sort of chugging along at this 6% number, I do think you'll see a healing of balance sheets and a recovery in the savings rate gradually. What's also hidden in these numbers is a bit of a K-shaped recovery. Higher end or higher income consumers have come out of the pandemic quite well. So when we look at things they would spend money on, those are doing extremely well. It's the bottom of the pyramid consumers who've struggled a little bit more coming out of the pandemic. And that's why lower end consumption in India. So if you looked at the lowest level of motorcycles sold in India, that's still to recover to the pre-pandemic levels. But if you looked at the sales of Mercedes-Benz, BMW, and Audi in India, they're now running above the pre-pandemic level. So, I think it's that difference which shows up in this number.
Thank you, Vetri. The last question is for Ajay. Given that the banking and financial service sector is around a quarter of the strategy, what is the growth looking like for the banks in India? How do you see this evolving over time? What could be the breakthrough?
Sure. So I think the most obvious driver for growth for the banking sector is credit growth itself. I did mention when we were talking about Kotak Bank, the fact that India's household debt to GDP still remains very low. And of course, the fact is that we are seeing a very strong surge in consumption as the per capita income improves. The ability of the typical Indian household to leverage would also go up, all other things remaining the same. That's point number one. I think credit growth in the Indian economy could remain in low to mid teens. And we feel that well-run banks could actually take market share away from public sector banks. That's something which has happened over the last 2 decades, more than 2 decades. And I think today, collectively, all of the PSU banks still have about 60% market share. This market share can continue sliding down. So we remain excited about the opportunity that some of the private sector banks have purely from a lending perspective. The other thing is that financial services per se in India, beyond just the pure lending activities, are also underpenetrated. Whether you look at the number of households who are invested in the market by way of mutual funds, if you talk about the insurance penetration in the country, all of these services have a very low penetration. And the 3 large banks that we have in our portfolio, ICICI, HDFC, Kotak, they are financial supermarkets. They're not only large banks and great lenders, but they also have very strong offerings in asset management, in insurance, in wealth, and so on. So I think, the future of financial services in India is very bright. We have to be very sure about who are we lending to. The typical litmus test is usually when the economy is down and is suffering, and that's when credit costs show up. And I think our favorites have been such institutions who have walked away from business because they thought that the risk was too high. So we continue to back these institutions. Yeah.
Thank you, Ajay and Vetri, for such an insightful session. I would also like to thank all the attendees for joining us today for this session.
Thank you.
Thank you, everybody. I know we've overshot our time, but thank you so much for staying along and being so patient with us.
Thank you, everyone. Have a good evening. Bye-bye.
Thank you.
Thank you.